Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Jared Blickery. Let's get you up to speed on the market action. Stocks taking a bit of a breather today as investors assess some of the comments that we got from Fed Chair Jay Powell over testifying on Congress. The Dow right now trading pretty flat. The S&P 500 down 7 and the Nasdaq down 95. Jared Blickery over at The Touch as always with more on today's trading action. Jared, what are we looking at?
That's right. The secret word of the day is not transitory, it's temporary. That's what Powell is calling that pause, and more about that in the bond market in a second. But we have the Dow, which is basically flat right now, just barely in the green. S&P 500 down slightly, and the Nasdaq, tech-heavy Nasdaq, down 0.7%. I say tech-heavy because tech is taking a little bit of a backseat today, really not reflective of what's gone on this year. But I did promise some answers in the bond market. Here is the bond market volatility index, B of A move index, and you can see it's been heading down for the last 3 days. Pretty impressive to see that. I'll also take a look at stock market volatility. This is at multi-year lows as well. So this is a time to load up on protection when you don't need it and when it's also cheap. Hint, hint. And then we also got to check out the 10-year T-note yield. Not a lot of volatility today. Sometimes we see that with Powell or another Fed official in front of Congress, but the 13-week T-bill yield, that is where I am focusing my attention. We had a drop to the 5 level and then bounced right off above it. And I think the market might be saying, okay, we believe you, Powell. We might see some higher interest rates this year. I want to move on to some of our heat maps. This is the sector action for today. Energy in the forefront. That's with WTI crude oil up to about $72 per barrel. After that, it becomes a little bit defensive with utilities up 0.7%, but we also have industrials, materials, staples, healthcare, financials, all of these in the green and outperforming to the downside. I said tech was suffering today. That is the case. XLK down about 1%, and then XLY, that's the retail sector, and XLC, that's communication services, houses Alphabet, Meta, etc. Those are taking the biggest slump. Here are our leaders here. What's interesting, we saw a big breakout in Bitcoin. We're going to be tracking that for you. And then Chinese stocks not doing particularly well today. And let me get a quick check on Bitcoin. Up 7%. Let me just get a year-to-date chart because this was a bull flag, and we started breaking out a couple days ago, but really got momentum over the last 24 hours with some excitement over a Wisdom Tree and BlackRock ETF. Akiko.
Okay, Jared, well, as you pointed out, the S&P 500 and the Nasdaq facing some pressure today as the Fed Chair Jerome Powell pointed to raising interest rates somewhat further by the end of the year. Take a listen to what he had to say to lawmakers as part of his semi-annual testimony to Congress.
The level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
And while the Fed waits to study the effects of their previous rate hikes, Wells Fargo's Chris Harvey says only the Federal Reserve will be able to put a pin in the tech rally. That's at least according to Bloomberg. For more on this, let's bring in Lee Munson, Portfolio Wealth Advisors President and CIO. Lee, going back to those Chris Harvey comments, he said specifically that he's starting to see similarities to what we saw back in '99 as well as 2000. Essentially that it's the Fed's aggressive move. They would have to break the economy in order for the tech rally to roll over. Is that what you see?
Wouldn't that be nice? Wouldn't that be nice if it was just the Fed that was going to be a problem? It wouldn't have to do with the level of interest rates, because this guy just came on today and told Congress that he's going to take his sweet time on if they raise a little bit, but he also is trying to, imply a little bit that he's going to take his sweet time lowering rates. High rates are not healthy for long duration assets, and that includes big tech and long 30-year treasuries. So this isn't where I necessarily want to be if it's going to be another year or 2 years where he's going to keep this federal fund rates high. I'd like to look at something else. And a lot just because we've had such a run up in some of these big tech stocks, and that's what's leading. I need to see more breadth in the market. Everybody talks about it, but what are we talking about? I need to see the actual stocks that have to do with the economy start to rally here. And they have, but I need to see us to get overbought, sell off a little bit, and then get overbought too. And we got to get through next earnings because we still have bears saying the economy's going to crap. I'm not seeing that outside. All I see is profit margins at risk.
Well, let's stick with earnings for a second because the last earnings season, the analyst community largely got wrong. Really, I mean, a lot of those beats were incredible, and that, I would say, in part fueled this incredible rise. There are other tailwinds in the market right now, but what's your projection in a month when we're staring at Q2 earnings?
Well, I mean, here's the thing. Obviously, the street thinks Q2 earnings are going to be just fine. Obviously, status quo says, consensus says, we brought down earnings enough, 10, 15, 20%. What's going to be the problem in Q2? But that's a problem is that we've richly valued some stocks as if there's going to be not just next quarter, but we're talking about multiple years of massive outside gains, partially because of this thing called AI. Because remember, January we were talking about going into the end of January, everything's going well. We said, well, we're buying these big tech stocks based on Fed cuts at the end of the year. And now it's like, oh no, there's not. Now it's because they're AI and we're going to have all this productivity thing. So I don't doubt that Q2 is probably going to be good, right? I mean, I think Bank of America, I think you see some beats in economically sensitive stocks, right? But the real question is, 6 months from now, are we going to see those interest rates starting to hamper not the economy, not surging unemployment, not caving housing prices, not raging energy prices, but are we going to see it start eroding those profit margins that came from cheap money, cheap wage, no wage inflation, cheap energy and commodities? And we're going to get to see, put it this way, in a month we're going to get to see how the economy is doing by looking at Bank of America's earnings, getting in their loan book.
That doesn't sound as sexy as AI, right, Lee?
No, it doesn't. Who wants to be a value player this year?
Let's talk about Goldman Sachs lowering the odds of a recession in the next 12 months. But as bets on the U.S. economy remain uncertain, there is one tip for investors who are looking to buy. Global investors set their sights on Japan's stock market as they look to catch a boom, aiding in the Nikkei 225 index rising to almost 30% this year. Japan is the market, Lee, we keep hearing about. In terms of overseas, we've seen Warren Buffett increase his holdings, at least in the trading conglomerates that exist there. How do you view that market right now?
I started going long a couple weeks ago, and I'll tell you why. As I age, I don't always feel like I have to buy something right at the bottom waiting for a turn. Sometimes, as Druckenmiller would say, you get in at the third inning of a baseball game. I love that the yen, 141 today? My eyes deceive me against the dollar. So they have cheap yen. They have some new governance things where they're being forced to get all this cash that's sitting in these Japanese firms invested. And I think for once, we might have a 1 or 2 year breather of Japanese people's 100-year recession. They are the #1 exporters out to China. They've taken place of the United States because they don't have the big political issues that we have with China. They're going to be selling to China for several years going forward. They even have a tiny little bit of inflation. If you can just look real hard, it's just real small like Hello Kitty. So I started taking a quarter of my emerging markets. Yes, why emerging markets? Because I obviously have a hole in my head, but I took a quarter of my holdings and I shifted it over to Japan because it seems a safer bet than betting directly on China. I'm more interested in the flow. I want to get out of valuations. I want to get out of a Chinese, communist, structure, blah, 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 blah. I think Japan could be a winner, and I think it's still got legs, and it's super cheap. Any value investor would look at this and say, oh my God, there's a margin of safety here.
Yeah, so we're talking about valuations here. Sure, largely, the Japan story has been about the structural changes that have been happening over the years, particularly around corporate governance. But I wonder if there's a particular sector you've been honing in on. But you look at Warren Buffett, he's really investing in the older part, the legacy businesses, you could argue, in Japan. Where are you putting your money?
Well, a few years ago, I got quite interested in some of the commodity trading companies that some of those younger people, it's a relative term over at Berkshire Hathaway, that they're interested in 2020. But I really don't. I understand that there's a lot of value players that have been looking at Japan, especially Japanese small cap, since like 1989. I would really prefer not to stick to a particular sector. I do think that if you need particular sector, there's stuff in tech, there's stuff in high-end manufacturing that I think is going to really increase possibly some of those valuation multiples. But I would caution people. Right now, we just have a reawakening. There's this country called Japan. It's a massive economy, and it's super, super cheap. And I would leave it at that and buy something broad base and wait for another 6 to 12 months to really see if you get some particular sectors outperforming. Because remember, with the yen this cheap, with exports so pumped up right now, with that governance thing, everything should be a winner in Japan.
Lee, I love this topic, and we don't talk probably enough about Japanese equities here because they haven't been interesting really for a long period of time. But can we go to the Wi-Fi Interactive? I have a chart of the Nikkei going back to the late 80s, and we are right now, we are short of the highs. You talk about that centennial recession. It's been 3 decades. Yeah. 3 lost decades here, and they're finally catching up. But are you worried something's going to break over there? We talk about the Fed breaking things, but they have arguably a bigger house of cards that could come tumbling down a little bit harder.
That's why I think it's important that you have such a huge discount in valuations. And that makes me more comfortable. But this is the smallest position in my portfolio right now. I just started getting exposure. And so what's going to have to happen is we're going to need to see a breakout. I need to see it close to 1989 again. And right there, that's where the point is, right? My first buy is right under it. But if this thing can hover around there and start breaking up and then fill in and break up and fill in and break up, then I think you have a winner. Just like the Nasdaq was, 10 years ago trying to get back to 5,000. But they have so many policy errors that they could make, right? And so you have to buy this stuff when it's 30, 40, 50% cheaper valuation than the US. And by the way, don't listen to these Japan bulls. They're like, oh, when it's a premium to the US, that's when you sell. No, it's when people start saying, gosh, you could see a premium to the US about a mile down the road. You say, I'm out now. Forget it, because I don't think it's ever worth a premium to the US.
Be a little bit forward-leaning there. Lee, stick around, stick right here. We're going to have you back in another minute. We're going to be digging deeper with you on stocks to buy, and we're going to be doing that in just a bit. Now, we're just getting started here on Yahoo Finance Live. Coming up, Shauna Smith is at KPMG's Women's Leadership Summit, and she's going to speak with former Secretary of State Condoleezza Rice, what she has to say about tensions between the U.S. and China straight ahead. Plus, we're heading back to the south of France as Brian Sazi and Brad Smith caught up with Walmart's Chief Marketing Officer at the Cannes Lions 70th International Festival of Creativity. And later in the hour, Yahoo Finance's Jennifer Schonberger sat down with Atlanta Fed President Raphael Bostic to discuss the Fed's recent decision to pause rates. All that and more when Yahoo Finance returns. Welcome back. Investors may have big tech on their minds as market faces economic uncertainty and also the potential for further rate hikes. But there are other ways to play, and investors may want to keep an eye on others to stay clear of. And here with more of this is Lee Munson. He's a Portfolio Wealth Advisors President and CIO. And Lee, thanks for sticking around here. Let's start with some of your picks. Occidental Petroleum. I've been fascinated with this ever since they bought Anadarko Petroleum back in the day. Reading your notes, it's all about the Permian Basin. And the CEO was roundly criticized at the time for paying too much, looking pretty prescient now, perhaps, and maybe hasn't had to walk it back as much. What do you like about Oxy this minute, though?
This minute is that they're 4 years into that merger, right? And so they've gotten the kinks out. I love that they have cheap production. I love that this place has half the Permian Basin in their back pocket because, I think a lot of people don't get in America that the Permian Basin is America's easy oil. It's huge, the fields are nice and rich, and it's easy to extract it. And then when those fields dry out, when your well gets dry out, you can pump all the stuff in it and get out through fracking. Occidental has some proprietary processes they do in fracking. Now, why is that important? I've got some clients that do fracking stuff, and it eats away at the major's profit margin. So if you can do stuff in-house and you can vertically integrate—
You're talking about not using oil service companies like Halliburton or—
Exactly. And so if you have part of that process that you're controlling yourself, and then you can get a profit advantage. And so it's all about having half in the Permian Basin, right? It's all about the Permian. It's all about proprietary knowledge on how to do parts of the CO2 fracking. And then, I'm not going to lie. It's nice to see Grandpa Buffett having a little floor on this and feeling like he's going to step in around that 59 level. But I think there's a lot more to it. Also, I think that there's a catch-up trade. It's a little off versus some of the others, and I think it's a good deal. But I think that goes for energy sector in general. It's beat up, and I understand that it did really well. But I think going forward, you have to think, how is this going to compound for the next 5 years? At what valuation? And things start looking attractive.
Yeah, a bit of a cool down that we've seen so far, at least in the energy sector. Let's talk about another name, or at least we should say two names that you really like in the tech sector. We're talking about Alphabet as well as Amazon. Now, Alphabet, you could argue, is the AI play that you were talking about earlier, but talk to me about how you're seeing these two names in the larger picture of the tech rally that we've been watching play out.
Well, when you look at the top 7, you can look at relative valuation over, say, like the last 10 years, okay? Now, let's take NVIDIA out of it because, great, you saw AI, you own NVIDIA, you get a big gold star. Have at it. You're almost about, where it was back in, late of 2021, a little higher, a little lower, depending on what the day is. I think that when you look at the other S&P 7, as we're now calling it, you've got Amazon, Facebook, Google, all at the lower end of their historical valuation, right? Which is crazy. I mean, they print so much money. For me, if I had a gun to my head, and then you ask, what do you own? It's like, a little Amazon, a little Google here, because I think that on a relative valuation, you get a catch-up trade. And when you're a guy like me who's a little bit more value-oriented, I don't want to hop on fads and lose a bunch of money, I think that that's important, especially if you're picking a basket of stuff that's basically the cause of the gains in the S&P, the vast majority of it, what's relatively cheap and why. Because, again, AI, no AI. I think the only AI plays NVIDIA. Everything else is just coattailing off of buy what worked before.
And nevertheless, the AI, that ticker, that money, the money ticker belongs to a company that's basically a microcap, maybe a small cap, C3 AI. There's a certain danger to just buying blind tickers, but that's something that a lot of people have been conditioned to do over the last few years. And then I got a question about the catch-up trade as well.
Yeah.
Intel, all right? If it's lagging, maybe it's lagging for a reason. That's why I might look at it at this stage, but your thoughts?
The story with Intel, I live out in New Mexico, and I'm a few miles from one of their big fab plants. And, you get the sense that this is such a large company. They control so much of the market. I don't think people understand how huge Intel is. But it's dead money. It's moribund, because they're too hooked into the PCs. It's always about, in 10 years, Intel's going to look like a different company. Well, I don't have 10 years. AI is today, right? So when you're looking at a catch-up trade, I'd rather have Taiwan Semiconductor, right? At least they have the fab stuff and are doing what the hot new stuff is, right? With Intel, it's always about in another year, we're going to transform, you're trying to move the Titanic. It's too hard. And I'd rather go with Taiwan Semiconductor. So that's my cue. And then AI.com or AI, the ticker symbol AI. Yes. So back in 2016, they changed their name from C3 Energy to C3 IoT for, remember, Internet of Things, yes. Right? And then when you go on their website today, they have this whole thing of like explaining the Baker Hughes deal. And it's like this 2-page memorandum like, well, we got this big client and because of that, we have all these other clients and we've taken half the revenue and put those into earnings now, even though they're 6-year contracts, but that's okay. And just you're like, if we needed to have a memo explaining things, then I think that that's exactly the poster child from when I came up in the business in .com, where everything changed the name of .com and changed this stuff. So I think that's going to be more. And again, I hope that this large language model is able to increase productivity across the board for 10%, because if it's not, we better have a stunning landing for the next 6 months. We better have the Fed nail it. We better have some large language models make us more productive to all the corporations of the world. Because if not, you're going to see increased volatility. And I think when you look at the MOVE index so low on the 10-year, it's like, buy protection, keep your options open, and why would you go out long duration on the bond side?
A lot of ifs out there, very, very tight rope for the Powell and Co. to navigate. Lee Munson, always great to see you here. Thank you so much.
Thank you.
Akiko?
Well, Tesla is looking to make a significant investment in India. CEO Elon Musk saying the company plans to do, in his words, what's humanly possible to establish a manufacturing presence there. This coming after he met with Indian Prime Minister Narendra Modi. Tesla is just the latest American company looking to expand its footprint in the country, and Modi is looking to capitalize on that interest as he begins his state visit here in the U.S. Let's bring in Rick Rosso. He's the chair of U.S.-India Policy Studies at the Center for Strategic and International Studies. Good to talk to you today. This is really turning out to be a bit of a tricky tightrope for the Biden administration. On the one hand, there's a lot of enthusiasm for business investments potential in India, and yet there's questions about their human rights record. What do you think the Biden administration is trying to accomplish on this visit?
Well, there's a couple of significant reasons to really try to build this relationship and underscoring that with a state visit. First and foremost, we see a more aggressive China in terms of security interests in the Indo-Pacific. India shares a lot of our interest in trying to make sure that we offset some of the more dangerous elements of China's rise. Although, the United States is more concerned about the Pacific theater and that threat, India is more concerned about its own neighborhood. Second, the economy. India has surpassed China as the world's most populous nation, 10 years consecutive of averaging 6% growth now. That's a pretty good track record. So when we think about high growth markets for U.S. investment and trade, India is going to be central to global growth. India also wants, of course, access to the U.S. market. So the size of the economy, the potential for the security relationship comes together nicely, I think, to tee up it's expected to be a pretty significant visit this week.
Are there any discussions now to link our capital markets to those of India? You think back to the U.S. and China, those relations back in the day, we really never got we didn't get a tremendous amount of cross-pollination, but we did get a lot of dual listings, and we still have those, even as China threatens to dial some of that back. I'm just wondering, might we see something a little bit more pronounced with the fact that the U.S. and business elements in India are more aligned and we're able to share our capital markets together?
Capital markets is still going to be tricky. India has a lot of deregulation domestically that it has to do. Foreign banks, foreign insurance companies, foreign pension firms, a lot of the big pools of capital still have limitations on what they can do in country. So you do see investors there. You do see companies in all those industries. But without being able to fully build out your business and operate freely in the market, there's still questions on what the ceiling for that's going to be. And frankly, to your point, this visit's going to have a lot of commercial overlay, a lot of security overlay, including strategic commercial issues and defense. But general commercial issues, including financial services, market access and such, I don't think are going to be a significant part of the agenda. They remain kind of unsaid and really an area for the two governments to work on in the future.
Let's talk about some of the challenges that are likely to arise here. You know, on the one hand, we've got businesses who are looking at huge opportunities. At the same time, you've got the White House sort of saying, you know, we're not going to lecture India on the human rights issues, despite the fact that some social media companies have been censored in some way, despite the fact that under the Modi administration, we have seen what some would argue is the religious persecution of Muslim minorities. And I wonder, when you hear the message coming from the White House, is it fair to say it sounds a little similar to what we heard about the opportunities in China many years ago, which is to say, we're going to de-link these two issues because the opportunities from a business standpoint is really significant?
I'm actually quite confident the president's going to raise these issues behind closed doors. He doesn't want to make a public spectacle of it, doesn't want to disrupt, the positive elements of our relationship. But I know that the State Department, the White House, Congress are all very interested to make sure that India, remains in the pathway of being a vibrant democracy. And some of these elements that we've seen on promoting intolerance on religious issues and such, to see that tamped down, especially as India heads into its own election season. But I think, again, that'll be handled privately. I think the upside on security cooperation and commercial cooperation is big enough where that's really going to be, at least publicly, the highlight and the most visible elements of the visit. But privately, that'll come up pretty prominently.
We just mentioned Tesla, Elon Musk talking about potential opportunities in India. Obviously, Apple, another one. We've heard many companies talk about this potential, especially as they try to reduce their exposure to China. We have heard about the opportunity in India for many, many years now. Is this time around different? Do you get the sense that India has the infrastructure, has the regulation in place to allow for this big push to bring in more multinational companies?
I wouldn't say the government of India has necessarily been running to position itself as the next best option. There isn't, frankly, a lot of deregulation that the Modi government would necessarily need to do. A lot of that lies with state governments, and there where you don't see quite as much action as what would precipitate, I think, a major wave of U.S. investment. So you've got a couple of great one-offs, most of which you just mentioned. But if you look at India's own numbers on foreign direct investment coming into the country, it's actually dropped by about 20% in the last 12 months versus the 12 months prior to that. So you're not really seeing the numbers showing a groundswell of investment, but gosh, when the big telecom suppliers and others do start making announcements, maybe this is kind of the first wave, but I think we'll have to check in another year or two and see if the numbers kind of prove that it's more than just a few very visible one-offs, and there actually is a groundswell of U.S. companies making those big investments. Right now, the data doesn't show it's happening.
Okay, and I know you're going to be following that one closely. Rick Rosso with CSIS. Good to talk to you today. Appreciate the time.
Thanks.
Well, coming up on the other side, our very own Jen Schomburger is catching up with Atlanta Fed President Raphael Bostic to discuss the Fed's recent decision to pause rates. Plus, Shauna Smith at KPMG's Women's Leadership Summit. She sits down with former Secretary of State Condoleezza Rice. Those conversations when Yahoo Finance returns. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. In an exclusive interview with Atlanta Fed President Raphael Bostic, he told me he favors holding rates steady in the current range of 5 to 5.25% through the end of this year, and he doesn't see cutting rates for the bulk of 2024. Bostic is towing the line between not jacking up rates too high to force the economy into recession, while also being mindful of trying to bring inflation back down to the Fed's 2% target. Take a listen to my interview.
My baseline is that we should stay at this level for the rest of the year. But implicit in that is that a lot of things are going to happen in the economy that really signal that the level we're at is sufficiently restrictive to get inflation back to its 2% target. Look, I actually think that we are still at the very early stages of our monetary policy tightening, starting to influence the economy in a significant way. And I just feel like we have a little bit of time to just let that play out and see exactly how much the economy is responding to our policy. I'll just add one other thing on this, which is that when I think about sort of my metrics of urgency, there are really two things that I'm focused on. One is the trajectory of inflation. If it starts to move away from our target and is not doing that today, then that would be a concern. And the second would be long-term inflation expectations. If I start to see that inflation expectations are starting to migrate out away from our target, that has some troubling implications for our policy and for where the economy is likely to go. And it would tell me that we definitely need to act a little more rapidly to get inflation back under control.
The market's pricing in a rate hike in July. Many of your other colleagues see 1 to 2 more rate hikes this year. It's safe to say that you would not vote in favor then of hiking in July.
Well, look, there's still a lot that's going to happen. And, so much of what people's forecasts are, what my colleagues' forecasts are, have implied answers to a lot of things that are uncertain. Are we going to see continued tightening in banking markets as we started to see through the spring? Is our pandemic era policies closing down and winding down not going to have that much of an impact on demand? Like, these are things that are going to resolve themselves in the next several weeks. I'll have a much better sense of what we need to do. But again, I do feel like we're in a position now where some patience can do us well. And look, I really want to try to do all I can to make sure that we avoid significant economic downturn.
To your point, you wrote in that outlook that it's really been the past 150 to 175 basis points of tightening that's catapulted you, the Fed funds rate, into the restrictive territory for really the past 8 to 9 months, as opposed to 15 months that you've been raising rates. So my question is, how much of a lag effect do you think we're seeing this cycle around? Is it slower than in the past? And how much runway before you think the economy really feels the full brunt of your policy?
That's a very good question. The research says that these lags really start to reveal themselves anywhere from 6 to 24 months. That's a pretty big window. By my calculus, we're at 8 to 10 months. So we're just starting to get to the middle of that range. And I would expect that over the next several months through the summer, we're going to start to see that tightening. Now, if we don't see the economy slow down, then I would have to reconsider my position and think hard about whether we need to move forward. But I still think we're kind of still early in the game in terms of seeing our restrictive policies impacts. And I'm very comfortable waiting. But I'm a member of a committee. The committee is not there right now. We'll see what the data bring over the next several weeks.
President Bostic, how do you view credit conditions now? Do you think that the bulk of the credit tightening that we saw from the bank failures this past spring has worked its way through the system? Perhaps we'll see a little bit more on the margin, or do you think there is more significant fallout from that to come?
Well, I think there are really two things to say here. One is that the first bit of trouble happened around liquidity. And I do think that those concerns are a little lighter in my mind right now. The facilities that we've put in place, I think, have gone a long way to making depositors and banks more confident they can manage that. but there is still some credit risk that has yet to reveal itself. You know, I did a lot of work in real estate when I was a professor before I took this role. And when I talked to my contacts throughout that industry, they told me there's a lot of uncertainty about what's going to happen with commercial real estate, offices in particular. As those troubles start to bubble up, we'll have to keep a very tight eye on what happens in terms of bank lending standards and in how the sector more broadly starts to affect other types of economic activity.
You said you really want to strike a balance here, take a step back and wait. Are you worried that if you were to do more rate hikes, that could tip the economy into recession? The fact that many of your colleagues on the committee see doing at least two more rate hikes this year, does that worry you that if the committee were indeed to raise rates 2 more times this year, that would raise the odds of a recession?
Well, what I would say is this. I've been informed by history. Like my team here, they talk about economic history a lot. And when researchers and scholars look back at Fed actions, there's often been a conclusion that the Fed has always gone like 1 or 2 steps further than they absolutely needed to. And I just have that in my head as something that we should be mindful of as we think about the trajectory of our policy. Look, we have so much uncertainty in the world today. We've been through a pandemic that frankly, I didn't think we would be experiencing a month before it happened. We've had war in Russia and Europe that was inconceivable before, like through my lifetime. So we've just had one unexpected thing after another. And I do think that like just letting the world happen, our policies in a restrictive stance right now, I'm seeing signs that the things are slowing down. We're getting more into balance. Labor markets are easing. Now, all these things tell me that there's really an opportunity for us to have significant slowdown, a significant continued reduction in inflation, and steady movement back to our 2% target.
Looking at the summary of economic projections, the interest rate projections, if we look out to next year, the committee as a whole seems to be projecting rate cuts, looking at about 4.6% next year on the median from 5.6%, which would be about 100 basis points. Obviously, that would be different for your forecast, but I'm curious what your thought process is around when the Fed would begin to cut rates next year, if it would be in the beginning of the next year, and how you think about that as inflation comes down, and perhaps that gap would mean that you end up being more restrictive.
Yeah, so, you know, I would say this. I'm expecting inflation to come back to target in a very measured way over the course of an extended period of time. Our history has told me that the first part of an inflation reduction can come relatively easy and actually not even that fast, but relatively easy. And now we're at the part where we've got to see services inflation start to decline. Wages in those sectors are stickier than in other parts. And so it's just going to take a bit longer for inflation to get all the way back down to the target that I expect. So I don't have a rate cut in my forecast, in my baseline forecast, for the most part of 2024. I think we'll have to just let inflation take its time getting back down to our target. Our policies, I think, are strong enough to make that happen. And you know, we'll just let the experience tell us. Now, this is all again on baseline, right? And if the economy were to remain stronger than I expect, then of course I would have to consider accelerating or changing my stance in terms of how restrictive we need to be. But again, that's not what I'm expecting to see happen. And we'll just have to see where the world takes us.
Of course, of course. Switching gears, President Bostic, the Federal Reserve released financial disclosures for regional bank presidents last week. And you disclosed as part of that a third-party money manager bought and sold exchange-traded funds on your behalf on May 2nd, 2022, during a blackout period, just days before a policy meeting. Are you aware of these trades that are being made on your behalf?
Well, look, I've said a lot about this in disclosures both this year and last year. And the most important thing is that they have been corrected. Those sorts of trades should not happen anymore. And I really can't say much more about that in terms of detail because this is being investigated by the Federal Reserve Inspector General, and I want to let that inspection play itself out, and we'll just see where we are at that point.
Is there anything you're looking to do to make sure it doesn't happen again in the future?
So I've already done those things, and I'm not expecting we'll have this as an issue moving forward.
And my big thanks to Atlanta Fed President Raphael Bostic. Jared?
All right. Thank you, Jen. And just thinking about it, Kiko, some of the comments by Raphael Bostic here, really interesting to watch some of the other wire services pick up our interview. But one of the key headlines here, my baseline is to hold rates steady through year end. And he was just talking now, if I heard him correctly, he's talking about maybe pushing it out until later of 2024. So that's his baseline. You compare that with Powell, who, listening to him earlier today, still expecting some more rate hikes this year, not fait accompli, but everybody's kind of in a holding pattern. And I think the biggest message here is there's still a lot of work to be done by both Powell and Bostic, saying the easy work, if there is any, if there was any, that's done. And it's really time to hunker down.
Yeah, I mean, still a lot of work to be done when you consider that the Fed's target inflation is 2%. They like to look at core PCE at 4.7% right now, so it's still well off the target. What's interesting to me is what Raphael Bostic said specifically about how he's looking at that lag factor. Now, if you think back to the FOMC decision last week, it really was about sort of allowing the Fed's tightening policy to take shape before taking additional action. But this seems to be a little more specific here. He said specifically we're early in the game. It's 6 to 24-month lag, which is a really wide range right now. 2
years, 24 months.
If we're roughly 8 to 10 months in, you know, I think one of our guests said, it's too early to put out the mission accomplished banner. Certainly, we could start to see even more tightening moving forward. So that tells you sort of that really difficult line the Fed has to toe here in terms of keeping monetary policy tight enough to prevent inflation from going back up, but at the same time trying to accomplish what I guess we still call it a soft landing, to not necessarily break the economy there. Let's talk about another conversation here with KPMG holding its Women's Leadership Summit at Baltusrol Golf Club today, bringing together the most accomplished female leaders in business, politics, and sports ahead of this weekend's Women's PGA Championship. Now, when it comes to sports, the story that's been dominating the headlines is that surprising agreement between the PGA Tour and LIV Golf. Our very own Shauna Smith addressed that topic and much more with former U.S. Secretary of State Condoleezza Rice.
I'm not privy to what this agreement actually will mean. It looks like it's still being worked out. I'm a fan and I'm a golfer. And the one thing that I really hope is that it reunites men's professional golf. I miss some of these golfers. And I think that the golfers who have spoken out and have been willing to hang in there, they deserve our respect. And somebody has to think about what their choices meant for them. But as a fan, I really do want to see Cam Smith and DJ and Brooks play again. And so I'm hoping that this reunites men's golf.
Do you see it reshaping the game of golf at all?
Oh, I think the game of golf is being reshaped anyway. I think you're getting players who are much more vocal about what they need and want from golf. This is a place that I think the LPGA, I'm delighted that KPMG is here at a historic course like Baltusrol. I mean, this is a place where championships are won. And the women's game, I think, is going to really take a leap forward, too. And it needs to, because if you look at the talents of these golfers, they should be on the big stage more often. I'm really grateful that at Augusta National, we've been sponsoring the Augusta National Women's Amateur. And I have to just put in a plug, Rose Zhang, Stanford player, won it. But events like that are raising the stature of women's golf. And so while I am watching what the PGA is doing frankly, I'm much more concerned that the LPGA finds its rightful place on the big stage.
Yeah, and you certainly have helped move the conversation forward as one of the first female members of Augusta National Golf Club. As Secretary, also when it comes to China, that has also been obviously a big topic here over the last several years, really for decades. Secretary of State Antony Blinken just making his trip to China, the first Secretary of State to visit China in just about 5 years. I know you made multiple trips to China while you were part of the George W. Bush administration. What's your assessment just in terms of what our relationship with China is like today when you compare it to what it was about 15 years ago and the path forward?
Well, it was a much more cooperative relationship 15 years ago. And that's partly because the presidents that I worked with, Jiang Zemin and Hu Jintao, for some reason seemed to have a different vision of what China's role would be in the world. Very cooperative, for instance, on North Korea. That's not the China that we're dealing with today. And we have to recognize that this is a significant rivalry, a rivalry militarily, economically, a rivalry in terms of technology. And we can't sweep that under the rug. These are real differences. But I'm glad that Secretary Blinken went there because we do have to make sure that we don't stumble into conflict. The Chinese are doing things with their military forces, running awfully close to our ships, running close to our aircraft. That's going to end up in disaster. And letting them know that we're going to continue to defend the rights of freedom of navigation, but that they shouldn't come so close to our ships. That's a conversation you can only have in person. And I'm sure that Secretary Blinken had that conversation in person.
And bringing it back here to the U.S., lots of talk now about looking ahead to 2024. It's a fractured D.C. when you take into account what is going on between both parties, but also what is going on within each party. What do you see as the future of the GOP party?
Oh, I do international politics, all right? I'm a Republican, everyone knows that. I hope it's a party that continues to advocate for a strong role for the United States in the world, for the power of free markets, for the power of individual liberty and individual responsibility. But also one thing that I'm very proud of is that you're seeing an awful lot of people advocate for better choices for poor kids and their parents in schools. I am a very major advocate for school choice. Not because I don't believe in public schools. I do believe in public schools. But I also know that if you are a parent of means, you can move to a district where the schools are good and the houses are expensive. You can send your kids to private schools. So who's left in failing neighborhood schools? Poor kids. I just want those parents to have the same choices that parents of means have. And I have to say, school choice has been the banner more in the Republican Party than in the Democratic Party. So maybe when we think about these parties, we need to look really closely at what they're saying about these key issues. But as I've often said to people, when I'm ready to make comments about American politics, I'll call you.
Secretary Rice, thanks so much for your time.
Waiting for that call. That was Shauna Smith with former Secretary of State Condoleezza Rice. Bitcoin extending its run higher, now topping 30,000, and it comes as Wall Street is giving the sector a vote of confidence thanks to a new exchange and ETF applications, and those were coming from BlackRock, Invesco, and WisdomTree. But our next guest says that even though we're seeing strong performance in crypto ETFs, the flows are still lagging. Joining us now is VettaFi Associate Research Director Roxana Islam in this week's ETF report brought to you by Invesco QQQ. So let's begin with the latest news here. And I want to call up the Wi-Fi Interactive where I have a 3-month chart of Bitcoin on the screen here. And you can see this down movement right here. That was actually a bull flag as part of another big uptick here. But in the last 2 days, really broken up. And I would say that the stage was set technically, and then we got word of the WisdomTree and the BlackRock ETFs. How much, and this is for a spot Bitcoin ETF, which is different from the futures Bitcoin ETF, is this really going to move the needle?
Yeah, I mean, I think this is an exciting event. among some of the action that we've seen this year. I mean, for a while, everyone was sort of looking at crypto and they weren't as interested as they were in the pandemic. And now everyone's been talking about crypto ETF performance again this year. And, if you look at some of the best performing equity ETFs year to date, a large portion of those are actually crypto ETFs. The best performing ones are, something like WGMI, which is giving you 170% year-to-date return. But there's been that huge mismatch between performance and flows. Normally, when you see something like that, that's giving that much performance, you're going to see investor inflows. And obviously a lot of that is based off of underperformance in 2022. But it doesn't change the fact that, if you're an investor and you got into this early this year, you would have made potentially 170% return. So, there's still this huge disconnect between flows and performance. And so I think investors are still shying away. But, now we're definitely seeing some interesting news coming here with some of these spot Bitcoin filings over the past couple of weeks.
Yeah, I mean, is that what's going to continue to drive the inflows? What have you seen in terms of the headlines that have particularly turned investors back to crypto after what we saw in the latter half of last year?
Yeah, so I think, first of all, there's several different types of investors we're dealing with. There was a lot of people that got into crypto during this crypto craze in 2020 and 2021. Maybe they were burned in late 2022, and now they're just not interested in crypto anymore. They don't really care about the good news. They don't really care if there's growth potential there. They're just hands off of crypto. And then there's maybe some bulls out there who, are still looking for some of that exciting price action. Maybe they were sort of waiting in the headlines earlier this year, waiting for something, maybe news like this to sort of boost the prices and sort of add to their positions. So, you have to consider several things. And, a large portion of these crypto ETFs, for example, are crypto equity ETFs. A lot of these are thematic in nature. So these have, broadly faded in popularity. People are a lot more into some of these large cap technology and communications names, things like semiconductors. And then from a thematic perspective, they're into, artificial intelligence has been the buzzword this year rather than crypto and the metaverse. So, a lot of people are seeing that as something that's, a little bit more tangible than maybe blockchain is, which is still something that you have to explain to an investor. So I think there's several factors going into this, but definitely there's still some investor interest and investor demand when you see these spot Bitcoin filings coming in.
I want to talk about bubbles and also AI. And first, let's go to the Wi-Fi Interactive. I'm going to show everyone a 10-year chart of Bitcoin. And I'm sure people here, some of us, remember what happened in late 2017, early 2018. That's when Bitcoin first peaked at 20,000. That was when a company could have fixed blockchain to their name and just see a meteoric rise in their stock price. And that gave way to another bubble a few years later. I'm just wondering where we are in the cycle here, especially with the rise of AI. Is there still room to get excited about blockchain and Bitcoin and Ethereum and NFTs in the way that we did a year ago, 2 years ago?
Yeah, and I think the market is still normalizing. If you look at what the crypto ETF market is now, it's actually a lot larger than a lot of people think. There's about 25 different crypto ETFs out there. And, there's a handful of those futures-based ETFs, but there's about 15 of those crypto equity ETFs. And so a lot of those crypto equity ETFs, they hold very similar things, and a lot of them are very small. Only a few of those have over 100 million in assets. And a lot of those are also, very relatively new. They all basically launched between that time frame between 2021 and 2022. And the latest of those actually launched in September 2022. It's been pretty quiet since then, except for a few closures. We did see about 3 of those ETFs close since 4Q22. And then also some of those crypto adjacent ETFs like NFTC, for example, which was the first NFT focused ETF. So, there's been some sort of consolidation within the industry, but, there's still that race towards the spot-based Bitcoin ETF, which I think has definitely picked up with that the BlackRock filing. That's something that is still very much in demand. And I think, once one person files, a lot of people will sort of fall into that race because there's a big first mover advantage when it comes to something like a spot Bitcoin-based ETF.
Okay, well, we are seeing a big bump, at least on this day. Roxana Islam from Vetify, good to have you on today.
And shares of Amazon, they're down today on news that the tech giant being sued by the FTC over alleged deceptive Prime membership sign-up and cancellation practices. Yahoo Finance's Dan Howley. Dan Howley is following the story and joins us now for more. Dan, what's behind this?
Yeah, that's right. This is a claim that the FTC has filed in a lawsuit against Amazon, basically pointing to its ability to get people to sign up without their knowledge or without their purposeful knowledge, and then making it difficult for them to cancel their Prime membership. So part of this has to do with kind of the sign-up process. You would go onto Amazon, see something that you wanted to purchase. There would also be an area where you would then be able to sign up for a Prime membership, and it would kind of be cloudy as to which one you were clicking, and then you were signed up. Then to quit, the FTC claims that Amazon put that behind some onerous steps that you'd have to take. So we have a statement actually from the FTC with regards to their complaint. They say that in many cases, the option to purchase items on Amazon without subscribing to Prime was more difficult for consumers to locate. That's basically saying that, you know, when they would go to press that buy button, you would then accidentally sign up. Then it sends, in some cases, the button presented to consumers to contemplate to complete their transaction did not clearly state that in choosing that option, they were also agreeing to join Prime for a recurring subscription. Now, we do have a response from Amazon. They say the FTC's claims are false on the facts and the law. The truth is that consumers love Prime, and by design, we make it clear and simple for customers to both sign up for or cancel their Prime membership. As with all our products and services, we continuously listen to consumer feedback and look for ways to improve the customer experience. They look forward to the way the case plays out. So this is just one of a number of ways that the government is going after Amazon. Obviously, FTC Chair Lina Khan makes no bones about how she does not agree with Amazon's practices. And so this is just another instance of that.
Okay, Dan Howley with the very latest there. Thanks so much for that. Well, coming up, the closing bell on Wall Street. Stick around. And there you have it, the closing bell on Wall Street on this Wednesday as we take a live look at the New York Stock Exchange. All three major indices ending in the red today, with the Dow down 101 points and the S&P 500 down 22. The Nasdaq seeing the biggest pullback on the day, down 165. And investors certainly sort of assessing some of the comments that we got from Fed Chair Jay Powell today on the Hill, essentially suggesting there will be additional rate hikes to come. Well, checking in on the price of Bitcoin, over $30,000 per coin, up over 80% year to date, hitting a 6-week high. Jared, we had this conversation in the previous block with our guest from Verify, who's saying essentially, look, it's not necessarily that all investors are back in favor with Bitcoin, because you want to differentiate from those who were really hurt significantly during the collapse last year. But at least for today, to your point, because of what we heard from BlackRock and Wisdom Tree, a lot of investors getting in, maybe a sign of optimism here.
I think so, or at least we're out of pessimism. I mean, what other bad news could come out with respect to crypto? I think there is one huge looming piece of news, which is that Binance runs into catastrophic failure. And I don't want to spread rumors. That's not even on my radar here, but that's something I was looking for. But absent that, we've had the SEC going after not only Coinbase, but also Binance. We've had the rash of bankruptcies last year. I think the market was just in the mood for some good news here. I was making the point that technically Bitcoin was poised for a breakout. We got some news here. Maybe that Chair Gensler here is not as anti-crypto as we thought, or at least is going to take his foot off the brakes here. But Bitcoin really up strong here. Let me show you a 2-day chart. I guess we're only going to get the intraday, but also you take a look at what's happened over the last 2 years, still in the bottom 1/4 of that range. And then I'm also taking a look at the chip sector. AMD and NVIDIA, big names in the red today, continuing a recent sell-off for the stock market and they are the stock market's most popular trade, because that is the next bubble, I guess, as market participants are seeing. But let's check out the Wi-Fi Interactive. Just want to show you the sea of red on your screen today. That's in the chip sector. And I think some of this has to do with the comments that we got from Chair Powell, is that we're not done. And maybe there's a little bit of hesitancy to throw money at this continued bubble trade in the midst of that, or at least in the face of that. But Akiko?
Yeah, Jared, you also have to wonder how much profit taking is happening when you consider just the incredible run up that we have seen in some of these chip makers. As we talked about earlier on in the show, it is the buzzword, and we have seen it increasingly getting frothy, especially with names like NVIDIA as well as AMD. Well, Tesla shares closing the day in the red after analysts at Barclays downgraded the EV maker to equal weight from overweight, pointing to the recent AI boom as to what's driving the current stock rally in past weeks. At the same time, Barclays also raised their price target on the EV maker to $260, up from $220 a share, with them seeing a significant long-term opportunity for Tesla. Looking through the note here, Jared, specifically when it comes to what we heard from Dan Levy over at Barclays, he says that that the market is overlooking some of the immediate term challenges, which includes potential price cuts with more competition there, as well as the pressure on profit margins. The market getting really excited over these partnerships with GM, with Ford, and then of course the potential for robo-taxis with Tesla licensing out that technology.
Yeah, well, most of all the great things that are going to happen with Tesla probably in the future, and not even the close future. And that's been the moat. That's been one of the moats that it gets investors excited about this. But yeah, still a lot of work to be done.
For more on Tesla, as well as a check-in on the market action, let's bring in George C., Annandale Capital founder, chairman. George, we've been getting a lot of warning signs here about the frothiness that's been happening in this tech rally. What do you make of it?
Thanks for having me on. I would say I think we may be in the dog days of summer and sloppy summer trading and lots of people on vacation, because the market looks pretty soft and pretty tired right here. And with the kind of market we've had so far this year, which has been just enormous and unexpected, it makes sense for the market to chop for a while here. And as we go into the fall, which is historically the weak part of the year, whether it's Tesla or NVIDIA or Microsoft or a lot of these tech stocks that have taken leadership, for them to pause and refresh at a minimum, maybe more than that. And investors should probably look at some of the things that haven't done as well this year and are very, very reasonably priced at this current time. So you may want to trim a little and add a little in certain other areas.
All right, so let's get straight to it. What else are you looking at, perhaps as a somewhat of a catch-up trade here?
Yeah, the discount store factor with the potential for a recession and with some weak earnings reports recently has really taken down Dollar General and some other comparable companies like that. And I think that's a great place to look, because that's a very, very fine company and a great long-term investment. And we also think the upstream oil and gas space has been really thrown out because it's so out of favor politically these days, and with many institutional shops in terms of owning these firms, and their balance sheets are immaculate and they're buying back tons of stock. And I think that long term, there's a secular bull market that's coming in commodities. We're having a pause this year, and we've had some diminution in the price of natural gas and to a lesser extent oil. But I think this is a great entry point for stuff like that. So it's a market of stocks, not a stock market. And there's always something to do in the market. You just have to be nimble and trade around your core positions. Keep core exposure to the markets, but trim a little here, add a little here, depending on what's attractive at that time.
Yeah, let's talk about oil and gas. It feels like it's tough to replicate the kind of performance we saw last year. Sure, they have fallen. Maybe this is a good entry point, to your point. But what do you see as the next catalyst that could move stocks to the upside, at least in that sector?
I think there's quite a few, actually. I think we're going to see a lot of M&A because some of these smaller players just really can't compete on their cost structure with some of the bigger players. So I think there's going to be a lot of acquisitions in the next 2 to 3 years. I think the commodities are going to come back strongly, and the stocks always rally during periods like that. And then you have managements that are really aligned with shareholders for the first time in 15, 20 years in this space. Previously, management lined their pockets a lot and overspent on the capital expenditure side and really didn't generate any free cash flow. And now it's exactly the opposite. These companies are generating gobs of free cash flow. Many of them are paying very high dividends, and they're buying back tons of stock with that free cash flow. So even though commodities are a bit soggy right now, I think that's a gift for an investor who's got a 2 to 4 year perspective, because I think you can get in very inexpensively right now on any potential metric and buy and hold and make a really nice return.
You know, we talk a lot about recession and the expectations for it. Is it going to be a hard landing, soft landing, no landing? But one of the things I've noticed historically that tends to precede a lot of recessions are oil prices, high oil prices. Oil prices double. A lot of times after that, you get a recession. I'm just wondering, do you have, if you're looking for this commodities bull market there, is that potentially on the back of a Fed that hasn't been hawkish enough? Is this playing into any kind of recession prediction that you have personally?
Yeah, I have actually been calling for a soft landing being more likely than a hard landing for over a year now. And so far, that's what's played out. But we could still get a hard landing. Who knows? I can't predict interest rates or commodity prices or the economy. But what I can look at is companies that have completely restructured their balance sheets and are very healthy from a cash flow perspective and have a very bright future. I think with all the political virtue signaling against oil and gas, that we're going to have a supply problem eventually, especially with the shale plays running out of prime drilling sites to add to supply. And the global demand for these commodities is going up, not down. So I think that's a really good setup for investors over a 2 to 4 year period. It's not a trade, it's an investment. I don't know what's going to happen in the nenext 3 to 6 months. It may go down even further.
All right. A big thanks to George C., Annandale Capital founder and chairman.
Well, the pool of homes for sale is shrinking. Redfin reporting listings fell to a record low in May. Yahoo Finance's Danny Romero here with the details. Danny, any sign that there could be some relief down the road, at least with more supply coming online?
Akiko, it's not going to be easy to find a home this summer. The lack of homes is really stirring up competition, pushing those prices up. Redfin says that the number of homes hit a 11-year low in May. Homeowners are reluctant to sell their home right now and list them. New listings plummeted over 25% on a yearly basis. The drop is causing bidding wars, something that we saw during the pandemic. And for example, in May, over 37% of homes that were sold above their asking price. That is still higher than pre-pandemic levels. And one realtor in Miami is actually telling his buyers to offer higher money deposits, also waive contingencies, which can be risky. Home prices are lower, but the drop is a lot smaller on a month-to-month basis. And some economists say that home prices have more room to fall given the fact that mortgage rates are rising. Plus, the Federal Reserve signaled that more interest rates hikes are expected this year, which could weaken demand and cause home prices to fall even further, Akiko.
And Danny, this report comes ahead of tomorrow's existing home sales data. And just looking at where it's been historically, we're at the bottom end of a 2-year range here, although we are a little bit elevated from December levels. For existing home sales, what are we expecting tomorrow?
Economists surveyed by Bloomberg are expecting a drop about 0.7%. And regionally, the focus will be on the Northeast. Sales have fallen more than 23% over the last year compared to last year's levels. Another area will be the West region. Sales have drastically fallen. They've fallen over more than 6% in April. And in last month's report, economists say that half of the country was experiencing price gains. And, we could see that again in this upcoming report tomorrow, given the fact that Redfin reported that prices are up and stirring up that competition out there.
All right, got to leave it there, but thank you as always, Danny. Coming up, Senator Cynthia Lummis, she joins the show to discuss the latest in all things from the Fed and also crypto. Stick around.
Bonjour, ça va? Well, even though I can't hear your response, what you're going to hear is what some of the CMOs, CEOs, business executives, and leaders who are here at Cannes Lion Festival of Creativity have to say about the current state of cultural relevance and how their companies are meeting the moment of today's society. Caught me getting into it there just a little bit. Everybody's excited. We're hype. You're hype. And why? Because we're serving up some of the best conversations that you're going to hear coming directly from the business executives you know that are in your home, that are in your pantry, that are in your kitchen. And we're bringing them to you here on Yahoo Finance. Let me get back to this.
Cultivated chicken. Yes, cultivated chicken officially entering the U.S. market. The USDA approved Upside Foods as well as Eat Just subsidiary Good Meat to sell the cultivated chicken. Now, both companies plan to introduce their product with well-known restaurateurs. Yahoo Finance's Brooke DePalma is here with the details. And Brooke, I was jokingly calling this Petri patties, but there's a little bit more to it, I hope.
There's a little bit more too, Jared. I mean, this cultivated meat, first, let's start with what exactly it is. It's made from animal cells and essentially these huge steel tanks. It's then fed nutrients in order to grow the meat. There's no animal bones in it. It's just the meat that's growing within this tanks. It's then harvested, prepared into recognizable shapes like think chicken nuggets or chicken cutlets, and then package. Now, the big news here today is that the USDA gave two companies final approval to sell their cultivated meat products, particularly when it comes to chicken, here in the U.S. So those two companies are Upside Foods. Once again, they actually got FDA approval back in November, and now they're able to sell their products. They're going to debut with three Michelin star chef Dominique Crenn at her San Francisco bar Crenn. In addition to that, Good Meat, once again, that's Eat Just subsidiary. They're known for Just Eggs. That's a brand that you may know more than Good Meat, but they're set to debut with Chef Jose Andres. Of course, he's known as not only a restaurateur, but a humanitarian as well. It will debut at one of his Washington, D.C. locations. No word yet on when exactly these products are set to hit the menus there or which exactly Jose Andres restaurant it will be at. But both companies ramping up production today based upon this USDA approval.
Brooke, what kind of price point are we talking about?
Yeah, well, Akiko, you and I spoke to Uma Valetti, Upside Foods CEO, back in December. And ultimately, because production remains limited here, right now, Upside Foods can only produce about 50,000 pounds with an expectation to be able to produce about 400,000 pounds in the near future. This is making the cost of these products higher. And when we spoke to Upside Foods founder and CEO Uma Valetti back in December, here's what he had to say about that.
Our aspirational goal at the moment is to beat the conventional prices. But initially, we're going to start off with premium pricing when we come into the market, which we hope is really soon. And that's because we are on a small scale. But in time, we expect our products to be at parity with conventional meat. But that's going to be 5 to 15 years away.
Now, a similar tone from a spokesperson from Good Meat, saying that pricing will be similar to that of a restaurant, saying, quote, "We strive to work with restaurant partners to price our chicken dish on par with traditional dishes. As we scale, costs will come down." Now, that spokesperson went on to say that they're actually willing to lose money here. They're saying we're not making money on sales yet, but it's important that our consumers are paying what they would for a traditional dish. There's no word yet on if and when these products will enter supermarkets. Of course, that is the goal here. But by starting with these restaurateurs, they're really looking to introduce, to gain customer interest, and then ultimately scale from there. And so this is just the beginning of what may become another cultivated meat war, I guess we could say. Stay tuned for more, for sure.
I like my meat wars cultivated, as I do my chicken. Petri patties, watch out, everybody. It's going to be a thing. All right, Yahoo Finance's Brooke DePalma. Thank you, as always.
None of it sounds appetizing to me. Well, bipartisan effort advanced in the Senate to claw back compensation from bank executives who oversee a failure. The bill grants the FDIC new capabilities to force the return of executive compensation in return for a government takeover to protect depositors at some of those troubled banks. I spoke to Wyoming Senator Cynthia Lummis on where she stands on the issue.
I support the bill that the committee just reported out of the Banking Committee. There were 2 no votes, but the committee was otherwise fully supportive of the compromises that were reached yesterday and over the course of the night So it would provide the 2-year clawback. It would include many amendments from members of the committee who were interested in different approaches. I do think the committee struck on a very fair compromise that incorporated elements of the Warren bill with the committee's work product.
What are you looking to tackle here specifically? I'm looking at the wording that calls for allowing regulators to remove senior banking executives who demonstrate misconduct in oversight. How do you define misconduct here?
Well, there are 3 components to what happened with Silicon Valley Bank and some of the other bank failures. One was the failure of the managing directors of the banks to manage their risk. Another was the regulators supervising these banks failed to flag those risks so they could be addressed. And then, of course, our economy, with all of the spending that occurred in the last 2 years, put the bonds that were backing accounts underwater. And those 3 elements really contributed mightily to the failure of banks. So in this bill, we're mostly addressing the bank employees and directors themselves to make sure that when bank mismanagement or regulatory risks are identified by the regulator, that there can be clawbacks of compensation. We know that in several of the bank failures, that directors of the bank took out funds or compensation just before the banks failed. And we don't want the consumers of the United States, especially through the FDIC insurance that covers fees associated with propping these banks up, to be borne by innocent parties, especially when you can identify bankers that took huge compensation packages or other means of compensation right before a bank failed.
There are those who have criticized the bill, saying this is a bit reactionary. You just highlighted 3 key elements here that really came together to create what was this banking crisis and the ultimate collapse of Silicon Valley Bank. If you take the issue of the liquidity crunch, how does something like this address that?
Well, it does not address the liquidity crunch.
I guess the question isn't that the bigger issue? Is that something that the Senate should be tackling?
Yes, that's something that the House and the Senate should tackle by quitting spending such ridiculous amounts of money that drive inflation and cause the bonds that were backing those accounts to be underwater. So our overspending as the Congress contributed to this. The other thing, though, is that regulators seem to be asleep at the switch. They weren't adequately flagging the risks. And then when failures looked like they were inevitable, we saw some bank officers and directors enrich themselves and leave their customers and the FDIC insured banks holding the bag. So this piece of legislation is not comprehensive. It doesn't address every component of this. It really only addresses being able to claw back compensation to bank officers and directors if that compensation was taken in excess and close in time to the failure of the bank.
You talked about some of the missed red flags, and you've been particularly critical of Fed officials who you say kind of missed the ball here. What more needs to be done on that front, you think, to make sure we don't see a repeat of this again?
We need to address that with the Fed, and that will probably come over the months ahead. I tried an amendment and withdrew it that would have included within our dual banking system, the regulators who are in a position to know the banks they're regulating, whether it's a state chartered bank or a federally chartered bank, and to have opportunities to be in on the early end of ferreting out bank mismanagement or undue risk taking. For example, SVB had something like more than 80% of its accounts in excess of the $250,000 insured limit. Whereas in my state, it's single digits, like 5 or 6% of the accounts are over the $250,000 insured limits. So the part of the problem with the way SVB was administered is there were so many accounts so far in excess of the insured amount that now other banks are going to have their assessments raised to help pay for this. The whole purpose of having limits on insurance to $250,000 per account is so you don't have bank failures that have massive uninsured account amounts that other banks that did not contribute to the failure have to then socialize because of the cost of the assessments.
Senator, I do want to ask you about what's been happening in the crypto space while I have you. Obviously, you've been a very vocal supporter of digital assets, creating a regulatory framework. We have seen the SEC take some aggressive action against Binance as well as Coinbase, charging them with operating as an unregistered illegal securities exchange. Has those recent actions, have those increased the urgency for some regulatory framework within Congress? And could we potentially see an updated version of the bill that you introduced last year coming in the weeks ahead?
Yes, you will see an updated version of the Lummis-Gillibrand Responsible Financial Innovation Bill. You'll see it in about 2 or 3 weeks. I was hoping you'd see it before the 4th of July, but Ledge Council has had to push it onto the back burner in order to address some issues that are very much on the front burner. But you'll see it soon. It beefs up the consumer protection components of the bill. We're trying to address the illicit use of digital assets. So there's enough personnel and authority to address the illicit use. We're still preserving the Howey test, but finding what we hope are clearer guidelines between what is a commodity and what is a security. We're adding a self-regulatory organization on top when new technologies come along that can have regulators and industry leaders in the room to help figure out how to shepherd them through a regulatory process. I understand why the SEC might have chosen to use a regulatory action with regard to Binance. That is not a domestic company, and it's very large. But I'm scratching my head about why they would do that with Coinbase. We know that Coinbase went to the SEC and asked for guidance on how to comply with SEC regulations. And they did not get an adequate response, and then were slapped with an enforcement action. To me, that seems like not the right way to do business in America. If you have an American-based company that comes into your regulatory agency and says, we want to comply, tell us how to do it, and they don't get an answer, and then instead get a high penalty potential in a regulatory action, that's not a good way to regulate. That's not a good way to do business.
Wyoming Senator Cynthia Lummis speaking to me earlier there about crypto as well as banking regulation. Well, coming up, could Ryan Murphy be leaving Netflix to return to Disney? We're going to go around the horn and check in on some of today's top trending stories when Yahoo Finance returns.
Brian Sazi, Brad Smith, Yahoo Finance fam, you know what it is. We're here at Cannes Lions in France, where we're bringing you coverage all week with the leading CEOs and CMOs of some of the household brands you know and love.
With all these ad execs here, Brad, I think I just have to buy something from someone.
What are you gonna get?
I don't know.
Maybe a drink. We're at the Lighthouse with the lookout for the latest and greatest coming from Cannes Lions Festival of Creativity here. We've been here all week and I've been quite impressed by the yachts, by the scenes, by the water that I have yet to get into. But we're gonna get into another great conversation serving up your way right now. Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Prasu Mermanian. We're breaking down some of the top trending stories of the day that we have had our eyes on. Guys, I've had my eyes on Amazon Prime Day and Target's Circle Day, just announced today. They're going to be happening in a couple weeks now, in that July 10th week, kind of the week after the 4th of July. Obviously have our eyes on that because there are big moments for those companies. I was looking into those numbers. We'll get into those numbers in a little bit, kind of how much they matter for a company like Amazon. But I guess just at a high level, I am not someone that gets excited about Amazon Prime Day, which is why I wanted to talk about it. I don't love the deals. I don't think they're that good. I think they're just steering you to buy Amazon products, which is fine. But I'm not a big Amazon product person. Are you guys Prime Day people, Target people, going to go do some pickup or no?
Well, I would say I have dabbled in Prime Day in the past, but like you said, the only real deal that I think I found was the Amazon Alexa. I did it for a Christmas gift, I think, for my younger brothers. You can get more than 50% off the Alexa devices. That to me is a good deal. Other than that, I'm not some person that goes and searches for these big mega deals. And personally, I don't think they have a ton of that for Prime. However, I know it's a big shopping day for a lot of consumers.
Yeah, and I noticed, Josh, we're looking at it today, the website for Prime has like a live streaming box in there with people like talking about, check out these noise machines, check out this like pumping gadgets.
Overwhelming.
Like, I mean, is it just them clearing out inventory they don't want anymore? I don't know, but we were surprised also by the effect of how big Prime Day is for Amazon sales. I didn't know how big it was. Yeah, I know.
Yeah, I was looking into that. I was very surprised. They said last year they accounted for about 400 basis points to the upside in sales for the quarter. So this will be in Amazon's third quarter earnings. Which I thought was very interesting. That's 4%, obviously, to the upside, very big for them. And I was reading back to last year, just seeing different commentary. Wells Fargo said in the July retail sales, Amazon Prime Day, they specifically called it out. They wrote a whole paragraph on it. And that contributed to positive retail sales for the month of July. Interesting to think about when we've been talking consistently about that consumer, right? Are we going to see the consumer slow down? Are we going to see the consumer slow down? Well, we haven't seen those retail sales number, and maybe Prime Day actually sort of boosts it again in July.
I just want to add quickly, 63% of Americans are Prime.
That is crazy.
Yeah, I mean, so that's like half the population, over half is eligible for the sale. So I'm not surprised it's so big, but the question is, are you going to buy the little like
40% off a TV? 40% off a TV was like
a
a headline one for me. That's not bad if you're in the market for a TV.
And you wonder if consumers are pulling back their spending a bit, considering we have high inflation, possible recession, if they're going to go to these deal days more, or if they're going to even pull back on that. So that's something that remains to be seen. But speaking of shopping, one high-profile producer is looking for his next big deal. That is Ryan Murphy. He is the producer behind big shows like Dahmer, American Horror Story, The Watcher. He is leaving his 5-year deal with Netflix and reportedly is going to Disney, where he'll be reunited with Dana Walden. She's the co-chairman of entertainment, close friend and confidant of Murphy. From what I've read, it's not super surprising that Murphy is reportedly going to Disney, considering he has ties to that company through 20th Century Fox, FX. But it does signal to me a new era for Netflix, because Murphy was one of those creators early on who scored these big, huge deals, a reported $300 million for 5 years. Shonda Rhimes, another one of those, $100 million multi-year deal as well. So you wonder if Netflix is going to continue that approach, or if they're going to be a little more selective and pull back a bit.
So that's my big question here. Would you invest in writers or actors if you're trying to attract people to your streaming service right now, right? Because I looked it up. The reports for Adam Sandler's deal for 4 movies was $250 million. Obviously, Adam Sandler's huge. I was a big Adam Sandler fan when Adam Sandler made the more popular movies, over 15 years ago now. I haven't loved the Netflix movies, and I would not get Netflix to watch those movies. So I don't know if that's the play versus having a writer that's going to write something like Dahmer, write one of those TV series that we talk about a lot. It seems like that makes more sense to me than just getting a big name actor.
Well, back in, was it 3 years ago when he signed that deal, Murphy?
5 years.
5 years ago. That was like the heyday of Hollywood showrunners making tons of money. The streaming money was coming out the wazoo. We all three could have pitched a show, made some money off it.
It set up an arms race, really, across all the streaming services.
Shonda Rhimes, like you said, Murphy, huge guns that they brought into Netflix to sort of boost their offerings. And now it's like, maybe that wasn't so worth it. Plus, because there's a mixed track record there, right, with Murphy and Netflix.
Right.
So now he's going back to where he was very successful, working with Dana Waldman, right? So we'll see if that works out. But I think you're right. I think it's the actors versus the showrunners.
Oh no, see, I would take the writer.
No, that's the debate. And I think it's the showrunners that are the ones you want.
I think it's risky in general, because just because you invest in a really popular writer, producer, actor, that doesn't necessarily mean that their content, that their shows are going to explode. And we saw that with Murphy. Really, his only 2 shows that took off at Netflix were The Watcher and Dahmer. He had a lot of other shows, Hollywood, The Politician. They just did not do that well. And Dahmer, that was towards the end of his 5-year deal.
So was The Watcher.
So was The Watcher. So you have to wonder that it's more so the show and whether or not that can take off in a certain way rather than...
You were hitting on what it means for Netflix. I'm curious what it means for Disney, though, too, when you think about, would they let him write a Watcher-style show or a Dahmer-style show that goes on Disney+. So then you're getting more of the adult side of Disney+. Maybe you put it in I'm totally spitballing here now, right? I'm going down that rabbit hole, but then you get more of an adult side of Disney+, and you get the parents to actually want to use Disney+ more, rather than it just being mainly for your kids and for like superhero movies and stuff. You get those kind of drama TV shows.
Or Hulu, right?
Yeah,
Like
you try
maybe
one
put
out
that
on Disney
Hulu.
Plus there, or you put it on Hulu. I think that'd be an interesting side that I'm not sure Disney Plus really has as a consumer.
And real quickly here, Dahmer is going to have a season 2. There's a season 2 iteration of that, and Ryan Murphy is still going to produce that for Netflix, even though he's reportedly going over to Disney. So perhaps that's something that's worked into his contract.
So sticking with Hollywood, I want to talk about the GameStop movie. We got a first look at that. Dumb Money is the name.
Yeah.
I think the GameStop traders and the AMC apes are going to be happy about that, but it looks pretty good. Interesting cast: Paul Dano, Sebastian Stan, people like that. Seth Rogen playing a hedge fund guy. Good cast, interesting story based on the Ben Mesrick book. I'm interested to see what this is going to be like. But Josh, I think we were talking about this before. It's like, I didn't realize there's 2 other docs on this.
I already watched the HBO Max on it, Pross. I already watched the Netflix on it. So this movie better be funny.
Yeah.
You're going to put Seth Rogen in that movie, and it's going to be hilarious.
Pete Davidson as well.
Right. Then it's a hit, sure. But like, it needs to be a pure comedy. I feel like it's already been covered, and it's also a very recent event. We've already covered the news side of it. You got to just make me laugh and make an entire joke out of this. But overall, I feel like we should be the target market here. And I'm probably still not going to see that in theaters. Like, I want to watch that at home and hang out, and I don't know how much that's going to be pushing like box office level movie for me.
Yeah, and there's a debate right now where it will end up on the streaming side of things. But, you know, Hollywood gets a bad rap of not being original, not having the original ideas. But I remember when this happened, and it did play out like a movie. It makes sense to me. And I do think for people that aren't so entrenched in the finance world, it's good to kind of get into the nitty-gritty of what happened, because it was such a cultural event. And it was so interesting how it all played out with these hedge fund billionaires and these day trader average Joes. It does go to show a lot of the flaws within the financial system. And I think of something like The Big Short, which to me, when I first watched it, I didn't know anything. And I feel like that educated me a lot.
Right. And
No. So continue.
And I think we had hedge funders versus the retail traders who were at home during the pandemic trading this crazy crap stocks, right? And then it all led to this congressional hearing with Gabe Plotkin with this printer in the back. They're like, well, this is the billionaire guy. And he said, we got a printer in the back there. So this became a huge like cultural phenomenon. I think maybe people like who weren't so involved in that have like going to revisit it 2 years later. We're going to consume all that content.
So that's the thing is like when you get to The Big Short thing, would The Big Short come out in 2015-ish?
Yeah.
More or less.
I think it was 2015,
Yeah, like it was pretty long after the event. I think right now you just have the event so fresh in people's heads, they don't need the recap. They want to laugh about it or...
They said they're going to look at it at all the different angles, right? The traders that just so happen to get involved at the right time, the hedge fund billionaires, the ones who missed out. So I'm interested to see how they lay it all out.
Paul Dano as Roaring
He's the
Kitty
best.
looks great as Roaring Kitty. So
That's all that matters.
I'm looking forward to it. Yeah.
All right, we'll come back for the discussion once it comes out in the fall.
The
right?
reviews, yes.
But that's going to do it for us for today. There'll be more Yahoo Finance Live on the other side.
Joining us now is Walmart Chief Marketing Officer William White. William, good to see you in person here. Thanks for joining us. Lots of key trends being talked about this event, from anywhere from the state of the advertising industry going into the back half of the year. Economy's a little slow. Artificial intelligence. What have been some of your top takeaways?
Well, I think personalization is something that's been increasingly important for marketers for quite some time, and I think is continuing to ramp up. The expectation from a customer that things are bespoke for them is continuing to rise, and AI certainly helps fuel some of that, and I think that's something that we'll continue to see for some time, and certainly part of the conversations that we're having this week.
There's been some, I call it chatter, that Walmart in the second half of this year will really ramp up its rollbacks or its price cuts, and that's, to me, having covered Walmart for a while, that's what it does best. That is when it is out there grabbing market share. How do you plan to market an event like that or a series of events like that?
Well, low price is something that's been consistent with our brand for, since the beginning. And I don't think about it in terms of cyclical times. I think about it as that's the thing that we need that's something that we stand on. We do a great job of running a low-cost business so that we can pass those savings on to our customers. We'll continue to do that. And I think, from a marketing standpoint, we want to be loud and proud about that. But we also want to be, as I said, loud and proud about the broad basket, about the experience. And I think the things that we're doing to make shopping both easier and more inspirational for our customers is just as important.
What's been interesting to hear from some of the chief marketing officers is how they're generating demand during a downturn in some of the more discretionary aisles that a Walmart even has. As powerful of a brand as you are, what does it take to get consumers back into some of those other aisles?
I think it is about, one, it starts with having a great assortment, period. And I think creating an environment where people can see that and be inspired by it. We're very focused on shortening that distance between inspiration and purchase. And so particularly in the digital and social space, how we not just inspire someone, but make it so seamless in that moment to drive to transaction has been capability that we've been building for the last couple of years, and something that we're focused on for the balance of this year and for the future.
There's been a lot of attention on marketing campaigns gone awry. I think about your competitor Target, even though I would argue that wasn't a marketing campaign, that was more of a merchandising issue. Bud Light, of course, too. Where do you stand on this? Do you see Walmart taking stands like these companies? And then, how do you capitalize on their shortfalls?
90% of Americans shop at Walmart. 90% of America lives within 10 miles of a Walmart. We have over 200 million people come into our site each week. For us, we are focused on that breadth of our customer base, standing for and being meaningful and relevant to all of our customers. And that's what we're focused on, quite honestly. Help how we serve them and show up in ways that are meaningful and authentic to them. That's really where we put our focus.
Are you still putting a lot of marketing dollars to work on social media? The messages, the content on these platforms continues to be polarizing, to put it mildly.
We're not looking to go in any extremes. We're looking to, as I said, to be relevant to our customers and show up in the places and spaces where they're spending their time in a way that inspires them to shop with us and to feel emotionally connected to our brand. And that's the thing, that's where we put our focus.
It's been amazing to see how much focus has also been placed on the digital side for Walmart and really ramping up that investment.
Absolutely.
In terms of that touch point for consumers, what can consumers look forward to next? And how does that start from the marketing efforts that the company puts forward and all the way through to the product?
So we spend obviously within marketing, across all aspects of the business, we spend a lot of time with our customers and listening to them and understanding them. And I find it so interesting that if you talk to any customer, usually the first thing they mention is their store. And that's incredible. That's an amazing asset for us. We're in 4,700 communities across the country. But we are trying to think of them, we're trying to have them think of us beyond their store and think about, we're right there in their pocket. And so many of the efforts that we're driving from a marketing standpoint are that first app to tap. And there's a little, from a broad marketing perspective, there's a little bit of a reframe, if you will, to help people think about us digitally first. I would just point to a campaign we have in market right now, Welcome to Your Walmart, where all of the digital semiotics, if you will, are digital based and are focused on, you know, the look of our app, how things show up and look in the app. And so that's just part of a reframe, if you will, to, I think, connote the digital environment for folks. But we're also really cognizant about how do we drive transactions in the moment digitally and through social commerce. And so for us, social commerce has been a capability that we've been building. We've launched a new platform called Walmart Creator pretty recently, which is a creator platform that is a one-stop shop, if you will, for the creators out there to find access to product, to be able to post across all social platforms, you know, with one click, giving them the digital tools to understand the analytics of how they're performing as they're monetizing shoppable products. And so I think how we bring creators on board, how we leverage the Walmart brand in the moment for our customers such that they can have a very seamless experience within the feeds that where they're spending their time to drive a transaction is critical for us. And you know, I'm proud of the work that we've done in that space, and we'll continue to ramp that in a big way.
All right, we'll leave it there. William White, Chief Marketing Officer at Walmart. Enjoy the sunny weather on beach.
Thanks so much, guys.
All right, we'll talk to you soon.
Awesome.
And thanks to Brad and Brian and Can there with Walmart CMO William White. Coming up, it's closing time here on Yahoo Finance. We get you caught up on top trending stories of the day and let you know what to keep an eye on for tomorrow. Stay tuned.
It is closing time here on Yahoo Finance Live. Here's a look at some of the top stories of the day. Federal Reserve Chair Jay Powell taking a hawkish tone on Capitol Hill today. He said the central bank has a long way to go in its fight against inflation. He also said 2 more rate hikes are still likely this year. He'll be back on the Hill tomorrow testifying before the Senate Banking Committee.
And Bitcoin extending its run higher, briefly topping $30,000. And it comes as Wall Street is giving the sector a vote of confidence. And this is thanks to new exchange and ETF applications from BlackRock, Invesco, and WisdomTree.
And the wait is over. Amazon announcing when it will be holding its Prime Day, the major sale running from July 11th to 12th. It'll only be open to Prime members. Even though the sale is still weeks away, Amazon's already promoting some of the big deals members can get. And because the sale is so popular, other retailers tend to piggyback off of it and launch their own deals. Target announcing it will launch its summer sale from July 9th to 15th.
And that's going to do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.